Ladies and gentlemen, my name is Nathan Austin. I'm the Dean of the Doctoral Programs here at UPSA, and I would like to thank you very much for coming in, honoring us with your presence today's public lecture. I think a slight correction. It says Dean Dr. Juonu, right? It's the Dean of Accounting and Finance. Thank you for coming. Now, as many of you may be aware, this is a time that the United States government is working on its Africa strategy, which is a policy as to how it should relate to African countries in terms of investment, trade relations. So this public lecture is actually very timely in the sense that perhaps African countries shouldn't be sitting idle when this policy formulation process is taking place, because it has major impact on us. So we are, in fact, we are thankful for the opportunity to have this discussion and hopefully have it incorporated in our thoughts in various ways as we attempt to benefit from the relationship with the United States government. Our speaker this morning is a visiting professor here at the University of Professional Studies, Accra. He's here under the auspices of the Carnegie African Diaspora Fellowship Program. It's a fellowship program which they fund and enable African scholars based in the United States, teaching in United States universities, to collaborate with African universities. He's an associate professor of accounting at Morgan State University in Baltimore, Maryland, USA. He obtained his PhD in 1998 from Wayne State University, Detroit, Michigan, specializing in economics and accounting. Before then, he was a Fulbright scholar at the University of Michigan in Ann Arbor, the USA, during which time he obtained his master in applied economics. Our speaker is originally from Uganda, a product of Makerere University, where he graduated with a BSc in economics. His teaching focuses on taxation, government, financial, and contemporary issues in accounting. He has over 18 years teaching accounting. He also offers training for a number of small business owners under the Goldman Sachs 10,000 Small Business Program in the Greater Washington, D.C. area. He's also a tax collector, a tax scholar, a tax scholar and a consultant and a CPA, a certified public accountant in the United States. And also he coordinates something that I'm hoping we will be able to do here. He coordinates a tax clinic at Morgan State University. The tax clinic essentially is an opportunity for the general public to walk into the university, submit their tax documents, and then the students that are studying taxation will then process the documents for them to be able to file, which is a good way of serving the institution. And we are hoping that his presence here will help us start that process. As an academic, he has to publish. So he has published extensively in a number of referee journals, including Tax Notes, Advanced Taxation, R&D Management, Journal of Accountancy and Financing, and many more. His research interests is in R&D financing, tax aspects on public policy, and financial reporting. Ladies and gentlemen, let us welcome Professor Buagu Musazi.
What I'm presenting is a perspective. It's not there yet. But we have to start. Oh, I'm going to give you some background first on why we need this tax issue. In the last 20 years, two major events have happened in the relationship between the US and Africa. Of course, most of us know AGOA, which I'm going to talk about in more detail. And also, China has become a major player on the continent, which was a domain of US influence. So these two things are now driving America's strategy in Africa. Unfortunately, AGOA doesn't seem to be going well. I'm going to come back to that. But before I proceed, do you know, does anyone know how we ended up with AGOA? Just for the sake of everybody, AGOA is American, so African Growth Opportunities Act. Basically, it opened up the US market to African exports. That's what it was about in 2000. But the way it came about was because prior to the year 2000, US contribution in terms of foreign aid to Africa was very low. And other comparable countries complained. The Uruguay round of course in 1994. So if you look at this diagram, let me give you time to look at it. It's about the official development aid to Africa by United States, United Kingdom, Germany, France, and Japan. From the year 1970 to 2015. If you take close attention to the time before the year 2000, you can see that US contribution was almost in the same range as other countries, these 4 countries. And yet, the economies of these individual countries are just fractions of the US economy. So, they were complaining that the US is not contributing fairly to Africa's economic development. President Clinton at that point started the African Partnership Engagement Initiative in the late 90s. And that's what culminated into AGOA in the year 2000. That's when Congress enacted it. And you can see, after the year 2000, you can see US aid pouring up from the rest of the countries. So from the year 2000 to 2015, that's 15 years, they have put in about $5 billion in AGOA, mostly to enable African countries to export to to the US. So it has been an export-led strategy for the last 20 years. Is it working? When we look at this data, this chart, it shows some exports related to AGOA or US imports to Africa. I want you to pay attention to this line here, US imports from AGOA countries. From the year 2000. Here is billions of dollars. Remember, AGOA started in year 2000. The column in maroon, brown, is US exports. So we can see US exports, Africa exports to US increasing up the year 2008, and then going down. If you look at this line here, it's back to this line. In other words, African exports are back to their pre-AGOA years. Something has to be done. Okay. Oh, by the way, the column in the center is AGOA-related exports. So, for instance, this at the top, that's the total exports of Africa to the US, and this one is the proportion of those exports that were AGOA-related. that proportion is going down as well. Okay. AGOA is for renewal in 2025. That's about 6 years from now. And I think Trump will be out by that time. But if Trump is in power at that time, it's not likely to be renewed. It will depend on the politics at that time. But whether it's renewed or not, its benefits are now questionable. I'm not going to spend so much time on Chinese influence. I think we all know about it. But it's not so much, it doesn't make the US very comfortable, especially in Africa. So it's also influencing the way the US is structuring its strategy or reviewing its strategy in Africa. Given that background, what are the possible solutions? One, reinforce AGOA, review it, or repeal it. Okay.
Hello.
Those are the possible solutions that will happen, but how are you going to do it? There's a call in the different circles in State House, or in the White House, in African interest groups, that saying that we should engage the American private sector more in this strategy. And so far, the Trump administration has responded somehow, not from a policy point of view, but from an administrative point of view. Last year, they passed the better utilization of investments leading to development, as called BUILD Act, basically consolidating all the different U.S. financing agencies, USAID, Export-Import Bank, the Meridian, they're going to become one organization. It's going to be like a U.S. development bank for development. Also, the Trump administration got what they call Africa Prosper Initiative. Also, this is like a one-stop center where people who are interested in investing in Africa can go. This is the website for Prosper Africa. I call it Africa Prosper, but it's from the Trade Department of the United States Department of Commerce. And what are they doing? They're saying they're building on the U.S. government's already robust presence in Africa. More than 15 U.S. agencies are working together to modernize U.S. capabilities and efforts. Okay, you can go down the line, but what I want to point out is this point here. Expand U.S. companies' access to information and provide financing support. Basically, they are talking about the U.S. private sector. Okay. I cannot cite all the literature I've seen calling for the U.S. private sector to come in. And what we are going to see proposed here, what I'm proposing, is what I think will cause some of the American private sector to get engaged in the U.S. in the African strategy. So far, for the Chinese, there are about 10,000 private Chinese businesses. Now, these are not sponsored by the Chinese government, just private Chinese companies. The U.S. SMEs are virtually missing. I don't know how many of you know any Chinese and American small businesses here, but they are not here. And nobody, so far as I said, talks about the tax incentives tool yet. And that's where we are building the case. Having done taxes for businesses in the US, I know how American businesses respond to taxes. We have even done some academic research to document this. There's a lot of literature showing businesses relocating overseas because of taxes. The advantages of using tax incentives. First of all, they are publicly visible as taxpayers prepare their tax returns each year. In the US, I don't know about Ghana, but businesses and individuals have to file tax returns every year. And I do part of that. When you put the tax incentives in the code, they will be visible almost for every business. That has an advantage because there's this general perception in Africa, in the US, that Africa is only suitable for aid. You can't do business there. But once they start noticing that there are business-related tax incentives that are related to Africa, they will start to think again. Okay? They're going to start looking for means of how they can take advantage of these tax incentives. Another advantage of these tax incentives is that you only get them when you actually invest in Africa. So they are given to the actual investors. Also, they are open to any business sector instead of being export-led. That's the problem with AGOA. AGOA is only for exports. Okay. So when you give tax incentives, they are across the board, unless you are targeting them to particular industries. But people are going to select and come invest in all sectors of the economy. Also, another advantage of tax incentives is that they can be used to equalize the after-tax profits companies make. You may not know this, but when American companies come here, they already come with a baggage of some costs that their competitors, Chinese competitors, don't have. For instance, they have to pay health insurance for their employees. They are not allowed to engage in corrupt activities. That already puts them at a disadvantage to compete. So giving them some of these tax advantages will offset some of those disadvantages. Also, because the tax credits, the instructions are easy, they tell you what you have to do to get this tax incentive. It's easier than applying for now grants, development grants from the USAID. I don't know how many of you have tried to get some of these grants from USAID and other financing agencies. It's not easy. You have to go through a lot. The Americans don't have that patience. Okay? But if you give them tax incentives, those are easy to get. So that's the general background of the why we should consider, or the US should consider, using tax incentives. Now I'm going to go into the details here about the type of tax incentives to use. There are going to be tax credits. A tax credit, if you are not from the accounting background, is the government gives you back some of the taxes you owe if you qualify. Okay, they use a formula and then they say your tax is $100. Okay, we're going to give you a credit of $20 back as an incentive for doing ABCD. Tax treaties these are normally agreements between countries where each country exempts the other country's activities from taxation. Then there are special deductions that are given when you are calculating your taxes. These are not necessarily new expenses, or they can be expenses you incur, but they can be magnified or multiplied 2 or 3 times before you deduct them on your tax return, just by tax law. For instance, if I spend $100 on my wage, on my salaries, employee salaries, the tax law can say, okay, we're going to multiply that $100 by 3. So instead of deducting $100 in salaries from your taxable income, you're going to deduct $300, even if you spend $100. Okay, that's a special deduction. So broadly speaking, the potential tax incentives are going to be falling in these 3 categories. I'm now going to, in the next 2 slides, I'm going to go into a little bit more detail here, but don't worry if you're not familiar with this lingo here. There are 2 types of credits we are proposing. The foreign tax credit, this one is already there. A foreign tax credit normally is if you report your foreign income to the US, but you already paid taxes on that income in the foreign country, the US will give you a credit for the taxes you have paid overseas. That credit is called the foreign tax credit. But as we shall see, they put limitations on it. And we are going to argue that for investors in Africa, those limitations should be lifted as an incentive. Another credit we are proposing are called economic zones credits. These are there in the US. What they do, Congress finds some areas that they need some activities to be done, and they encourage investors to go in those areas by giving them some favorable tax incentives. For instance, banks to convince banks to invest in low-income areas, they are given tax credits to open up branches in low-income neighborhoods. To encourage companies to go and invest in American they are not called territories, they are given credits to go and invest there. So what we are saying that why don't they extend the same concept to the American businesses that are coming to invest in Africa? Okay, those are called economic zone credits. I'm going to give you an example of how it works. Treaties, these can be bilateral, multilateral between countries. Double taxation agreements. Ghana has got about 13 already with European countries and some African countries, but the US is missing. Okay, the US does not have any tax treaties with African countries, as I shall show you. Sparing agreements. A sparing agreement is between 2 countries whereby if one country decides to exempt income from being taxed, the other country shouldn't tax it too. It should spare it. That's where the word comes from. Okay. For instance, I'm looking at Ghana tax incentives, and they are giving 0 tax rate for companies that invest in some areas here. So if a French company comes, invests in Ghana, pays 0 taxes, there's nothing that prevents the French government from taxing that income that Ghana have spared. In other words, Ghana would be exporting its tax revenues to France. Okay, but if there's an agreement between Ghana and France or US, whatever, that says, okay, we're going to exempt this company from France or from the US. If it does ABCD in Ghana, please, if it reports its income in in France or in the US, don't tax it. That's possible. Those agreements have been signed, but the US refused to sign them. The last attempt was 1957 with Pakistan, but the Senate refused to sign that agreement. Let me put it in perspective. Another example. If a US company comes to invest in Ghana today, it makes $1 million tax profit in an area where there's zero tax for Ghana, that company will pay 21% in the US on that income. Another category of treaties is income tax exemptions for African teachers, scholars, students. There are many scholars who go to America for different reasons, not necessarily students. And the US has treaties with European countries whereby when these scholars work there for 2 or 3 years, their income is exempt from US tax. There's no exemption for African scholars. Another category of incentives we are proposing are called special deductions. Again, I've talked about that. There's what's called net operating loss carrybacks. When a company makes a loss this year, it has no taxes to pay because it has no income. In typical tax law, they allow you to carry this loss to the other years so that you reduce your income in the future years. The US was even allowing you to carry it back to the previous years and reduce your income tax you have paid in the previous years and you get a refund. Suppose my company lost $1 million in Ghana this year, 2019. I could take that loss and apply it to my 2018 taxes. Remember, in 2018, if I had paid any taxes, I'll be able to get a refund from 2018 and use that refund money in my 2019 year. Unfortunately, that carryback provision was repealed last year. And we are arguing here that it be restated for companies that invest in Africa. Okay, I've done tax returns for businesses, and it can be handy to get that money when your business is struggling. Okay? Just to put in perspective, if we lost $1 million this year and carry back that loss to 2018, the US tax rate is 21%. So 21% of $1 million is $210,000. That is a refund we can get back this year. Okay, it's can be safer. Okay, so again, I'm going deeper and deeper in these 3 tax incentives groups. Okay, what I've given you is the broad explanations of what each of them are. The next slide or two are going to be somehow more detailed. Detail here, but I don't think I have to go through this. I've already explained it. Let me explain this with an example. Suppose we have company XY. It makes $2,000 profit in Ghana. It has $8,000 profit in the US.
and it pays Ghana tax of 25%. By the way, that is the Ghana tax rate. So 25% of the 2,000 is $500. So that's what it pays to Ghana. When it starts filing its taxes in the US, it will add its income from Ghana to its income from the US, and that will make $10,000. The US tax rate is 21%. So the US is going to say you have to pay $2,100. But we're going to give you a credit for the taxes you paid in Ghana. How much credit do you think they're going to give you? 500? No. Okay, intuitively, that's what it is, or it should be. But they put a limit. Okay? They are saying that, okay, you made $2,000 profit in Ghana, but as far as we're concerned, our tax rate is 21%. So we can only credit you 21% of the money you made, of the taxes you paid in Ghana. If Ghana's tax rate is higher, we're going to let you carry the balance on your books. So there's a limit of the credit we can get. So they're going to credit you $420 on your US taxes. And they're going to say the remaining $80, because you paid $500 in Ghana, but they're giving you a credit of $420. The $80 they're going to say give you 1 year. You can carry it back to the previous years, or you have 10 years to use it up, the $80. So if you don't use up that credit in that 11-year window, you lose it. We are proposing that the law be liberalized for investors in Africa, whereby we can use this $80 and use credit maybe back 5 years or 3 years instead of 1 year. I've done research and I published a paper in 2008 where we found that companies with this type of limitation do move their assets across continents to use up that unused credit if it's going to expire. Okay. Just an example. I don't want to go into much detail to make it more look like accounting. An example of economic zone credits, I pulled up an example from American Samoa. If you don't know, I think most of you know American Samoa. It's a territory, US territory. But they are trying to encourage American business to invest there. So they gave the American Samoa Economic Development Tax Credit. And this is how it works. If you invest in American Samoa, they are going to take 60% of your qualified compensation, that is salaries, and deduct that and give you a credit based on that. So if I spend $1 million in salaries, 60% of that is $600,000. I get a credit of that much. If another thing is 15% of your depreciation deduction for short-lived qualified tangible property, 40% of medium life qualified tangible property, and 65% of long life qualified tangible property. Basically, if you invest in property in Samoa, they're going to give you a credit based on these percentages, about 40% average. Basically, they're encouraging you to hire employees there and put machinery and equipment there. They're saying we're going to give you a credit. So we are suggesting that the same concept be extended to American businesses investing in Africa. Special deduction, this is not, I've already talked about this, but I can talk more about it. We said that carrying back losses was repealed last year. We are saying that an exception be made for American businesses investing in Africa. Okay, whereby if an American company makes a loss, as it's going to likely be in the first 2 or 3 years, let it be allowed to use that loss for its American taxes it paid 3, 4 years ago. Okay, companies will shop for these types of tax savings. Double taxation treaties. As I said, that countries can sign treaties whereby the income made in one country is not taxed again in the other country. Normally, automatically, that's done by giving a foreign tax credit, but we have just seen that they may not reimburse you all your foreign taxes. So treaties can be signed whereby we agree to either exempt the additional credit. The last year, Trump passed a law whereby American companies are now being discouraged from investing in low income tax rate countries. There's no way I can emphasize this, but taxes is a big deal for American businesses. They're going to do anything to save themselves taxes. So they do shop around the world for countries with low income tax rates. To the extent that last year, Congress passed a law whereby if an American company invests in a low income tax rate country, they are going to tax that income again. And as you may know, African countries are giving tax incentives to attract companies. So by default, African countries are going to be low-income tax countries. So we are saying that let African countries be exempted from this low-income tax rate country group. Okay, exceptions be made. And by the way, if we push hard, they are going to be made. We may not know it, but for AGOA to be passed, the World Trade Organization had to waive that requirement. If you are familiar with the World Trade Organization, you cannot exempt export duties for some countries. So the US had to seek for an exemption from the WTO for AGOA to work. I've talked about sparing agreements. US doesn't sign those, but we can push hard. I'm going to spend some time here on the scholars, African scholars. Okay, I'm going to put up a list of countries with treaties with the United States. Remember I talked about scholars who go to US. Has anyone been a scholar in the US here? You can get a visiting scholarship or even do a PhD. Okay. If you get a work there, by default, the income you make is going to be taxed. But there are agreements between countries where this income is exempted. And this is a list of countries with agreements with the US. They are in alphabet. I want you to count for me the African countries you see there. Okay. Of course, Egypt is there, right? What I'm talking about today is about Sub-Saharan Africa. Okay, so Egypt, okay, you can remember that. Okay. All these countries have treaties with the US. if you are a scholar from these countries, you don't pay taxes on income you make in the US. South Africa is there. But when I read through even that treaty, it was so funny. Okay. In this group of scholars, I'm including even trainees. So if a company sends trainees to the US to be trained, they can send them checks. They can pay them monthly. For the South African treaty, that's the only income they exempt in the US. In other words, African scholars still from South Africa still have to pay taxes on the income they make in the US. It's only the income that is sent them from South Africa that is exempt from the US. So that's the list. So we are, I mean, when you start looking at the tax laws, it's unfortunate that there are not many African scholars who are familiar with the US tax laws. You can see the unfairness there. But also I understand it because we are not active in pushing for these things. And that's why I'm here. I'm saying that make tax exemption for Sub-Saharan scholars, students, researchers, trainees, it is like it is done for other countries. Now, some data here. Anyone who have been in the US on a J visa, F visa? Okay, how to explain this? I pulled up some data from last year. You can go to the State Department, they can give you data on visas that were issued. If you're gonna be a scholar, trainee, whatever in the US, chances are they're gonna give you what's called a J visa. Typically, these are people who are sponsored by organizations. If you are sponsored by the US government, Ghana government, a US university, whatever, they're gonna give you a J visa. F visas are students who are self-sponsored. Now, last year, for the J visa scholars, a total of almost 340,000 visas were issued. And by region, less than 10,000 were issued to Sub-Saharan Africa out of the 340,000. Now, I have the African Association of African Universities here, Secretariat, Mr. Radford. Can you explain why we don't have many scholars from African universities going to the US? I'm not putting you on the spot, but it's something we gotta deal with. I'm glad we are opening up an office in DC. Okay, I'm yet to figure out what percentage of these scholars are sponsored by the US government, but the majority of them are sponsored by the US government. Okay, so we need some lobbying there to do. Note that almost half of these visas went to Europe. That means all those scholars from Europe made income in the US and they were not taxed. And a few scholars from Africa were taxed. I mean, it could be as simple as being a teaching assistant in a university or a research assistant. Okay, so I'm saying that not only do we have to look for the exemptions, but we have to find a way of increasing the intellectual engagement between the continent and the US. You know why? Because if American companies are coming to Africa, they're going to look for American-trained Africans to lead them. That's what they did in China and Taiwan. They were looking for Taiwanese to employ them in China. They don't send Americans there. They don't want to leave their comfort zone. They're going to look for people who are familiar with the region. And us having fewer trained American Africans, it puts us at a disadvantage already. This one is not a, these are students self-sponsored. 360,000 were issued. Of course, this reflects income. Almost majority of that was from Asia, probably Chinese, and only 18,000 from the US, from Sub-Saharan Africa. Those are the wealthy Africans sending their children to the US. There's nothing we can do about policy on that. Maybe they can give more scholarships, but we need more numbers there as well. There are some non-tax incentives. Though my topic is about taxes, but there are some non-tax incentives that one of them engage the African diaspora in planning. In other words, when you are making policies concerning Africa, try to work with the Africans, either with the African governments, African scholars, wherever they are. I believe if the Africans were engaged in designing AGOA, it would have been different. Don't you think so? Yeah. We sit on the sidelines and let them make policies for us. We have to change that. And the timing is so good for now. For AGOA before it's being renewed, we have a 6-year lag. We can make some policies that are now in addition to AGOA, or that can be used to repeal AGOA. Literature shows that returning migrants contribute to the countries of origin through brain gain. You guys were used to brain drain. Now there's brain gain, whereby people who went overseas come back with ideas and develop their countries. Another non-tax incentive, I don't know whether you know this point already, but when you hear the US gave us so much money in foreign aid, do you know that most of that money is not spent in Africa? They can give us food for $1 million or whatever, and 70% of that money is spent in the US on inflated prices. We have to have this policy changed. If you give us $1 million aid, we have to make sure that money is spent in Africa, because it has got multiplier effects it does here. Okay? So that's the presentation. I'm concluding saying that we are attempting to provide a policy agenda for Sub-Saharan Africa and the US Congress. Sub-Saharan Africa need to collectively be proactive and engage in US-Africa policy formulations. AGOA should be reinforced in countries where it is successful. Oh, by the way, remember the chart I put up for AGOA? Most of those exports are oil-related. That means oil exporting countries. And oil duties are not so much. The non-oil exports are dominated by South Africa, about 70%. And to put this in perspective, $20–30 billion exports for the entire continent, the US, that's nothing. Walmart sells at $200 billion. Pfizer, one of the pharmaceutical companies, they make $50 billion in sales a year. And the entire continent of Africa does not even export that a year to the US. So what are we going to do next? How are we going to push these initiatives in? We're going to seek audience with the U.S. House of Foreign Affairs Subcommittee for Africa. I'm on their mailing list. They sent me some things They invite speakers, so I'm going to see how I can push these things through there. Congressional Black Caucus, they are very active. They need ideas from Africans. Africa Prosper, we're going to also try to front them. Talk to my local congressman, and if you know other people, okay, and other African interest groups. And of course, we're going to try to publish these things to the tax audiences in the US. I believe the US companies will like these initiatives. Other than that, I'm going to ask if you have any questions, comments, to be good.